Francisco Blanch is with us now. He is head of global commodities research at Bank of America-Merrill Lynch. He called that 147.27 record that was last summer right on the nose, and he says oil is about to go higher again. We're very happy to have you with us. Thanks so much, Francisco, for being with us. So is it supply and demand? I mean, what do you think? What's the main argument for oil going that high over the next year?
Well, remember that we are right now at a cyclical low in terms of demand. The economy is around the world is starting to recover, but hasn't recovered yet. We have seen an improvement in leading indicators, but the actual demand for those barrels hasn't picked up tremendously yet. Now, having said all of this, interest rates are extremely low, and we are seeing increased liquidity, which is already impacting equity and credit markets. And I think all of that is ultimately going to result in real demand for stuff. And when that happens next year, you're going to see all those cyclical pressures building. And remember, we're trading at $80, and this is a low point in demand. So it won't take a lot to push oil 25% above the current levels.
You mentioned this $80 level, which seems to be psychologically key for the market. You had OPEC making some comments saying it would be raising production at its next meeting. We saw the market respond and, in fact, went below that $80 per barrel limit, or rather mark. How much of a wild card is OPEC right now?
Well, look, OPEC is obviously going to be always going to be a wild card, but remember, OPEC doesn't have a lot of room to maneuver when it comes to stopping a rally. They can do a lot to take barrels off the market when prices are coming off, but when prices start to go higher, OPEC's effective spare capacity is maybe 4 million barrels a day of incremental output. And if you look at the growth forecast that our economists are projecting for next year, which is around 4.2% for the global economy, and 4.5% for the global economy in 2011, that alone should bring global oil demand up by 2.5% next year and the year after. And that will be enough to wipe out any spare capacity that we have. So if we do get the big cyclical upturn that our economists are calling for, that should be enough to draw down those spare productive barrels that OPEC has in their bag right now.
Francisco, if we see a sort of W recovery or another shape other than a V, does your argument hold?
Well, of course. I mean, if we get into a double dip next year, of course prices will come off. But remember, it's difficult to envision how you get into a W unless oil prices go up higher, because that's the one part of the global economy that you can't really fix through either monetary or financial or fiscal tools. So that's one area where the ability of policymakers to change market structure is very limited. So that's one of the key risks to the global economy. And of course, if prices were to rise very quickly, that could put the recovery on hold. So to me, this is one of the key risks. Also, our chief economist, Ethan Harris, also highlights this is a key risk to the U.S. economy next year. Oil prices increase too quickly, we're going to be in trouble again. So it's going to be a very fine balancing act yet again.
Francisco, thanks so much for the time. Francisco Blanch from Bank of America-Merrill Lynch.